All right. Hello again, everybody. My name is Mike Rixey. I'm the lead options instructor for NetPicks, and I want to build on our video yesterday where we talked about buying long puts on Expedia. The trade ended up working out really well for us. I talked about how it produced a 75% return in 10 days. Really great trade, but I also talked about how it was a pretty aggressive position, right? We are solely dependent on the market making a big move to the downside. In this market that we've seen recently, we've been fortunate to have big movement. We know it's not always going to be the case. In fact, we're probably due for a stretch of some consolidation, some choppiness, and that's where most retail traders get into trouble. In this market, we've got the Fed raising rates, trying to fight inflation. We've had volatility return in a big way. The whole goal of these videos is to prepare you for continued volatility going forward. I want to give you a strategy set that you can use to make money consistently in many types of markets. That way you don't fall into that trap that most retail traders fall into of using strategies that work really well in certain conditions, but not well in others. And as soon as the markets change, they're in trouble and they don't know what to do to make money going forward. So yesterday, the long puts, that's the most aggressive route you can go. I'm not saying you shouldn't take those trades. I will use them quite a bit in my own trading, but it's only one tool in my toolbox. What I want to talk about today is a far more forgiving strategy, a trade that's going to give you 5 ways of making money versus only having one way of making money with a long call or long put. So we're going to use Netflix as our example. This is the same 130-minute chart. We talked about that in the video yesterday, and I should point out, if you did not watch the video yesterday, make sure you go back and watch it just so you get the full glimpse into what we're doing in these types of volatile markets. All right, the 130-minute chart, I love this chart because it identifies the swings really well without getting caught up in some of the intraday noise. If you go to a 5-minute chart, a 15-minute chart, they can work, but you've got to be careful. Very easy to overtrade, very easy to overreact to every little move back and forth. The 130-minute chart is going to give you 3 candles a day. It really does a good job of filtering out the noise while still keeping us very, very active. We are looking for swing trades here. We're not looking to day trade. I think day trading options is one of the most difficult things to do on a consistent basis. Swing trading, looking for positions anywhere from 2 to 20 days, that does a great job of preventing us from overtrading, keeping us very active, and just allowing us to stay more disciplined on a regular basis. Well, here on Netflix, if you take a look at our histogram down at the bottom, we had all of these yellow bars popping up. What do those mean? It means that price is between a 1 and a 2 standard deviation move on the upside. Everything that we do at NetPicks is numbers based. If I talk about a 1 standard deviation move, what that means is only 13.6% of all occurrences fall outside of that range on the upside. Doesn't mean it can't happen. It just means it's not statistically probable. Odds favor at that point either a period of consolidation or a reversal in the other direction. Well, if I start talking about a reversal, why not just go with a long put like we did on Expedia? Because with Expedia, we were okay being aggressive. We had a pretty strong directional opinion at that point, but I knew I only had one way of making money. That was the drawdown to that trade. Instead, I wanted a more forgiving trade on Netflix. I did not have as strong of a directional opinion. When I get an overbought condition like this, we know that overbought can stay overbought longer than anybody expects. So I want to have a trade that's not solely dependent on an immediate move to the downside. What we used here was a vertical spread, specifically a credit spread. And all that means is I'm trading 2 options at the same time. In this case, I was selling the 255 call and I was buying the 257.5 call at the same time to make sure I was in a risk-defined trade. I was utilizing the September 2 weekly options. I'm okay trading the weeklies, the shorter term options, as long as it's with a credit spread. If I only have 10, 15 days left to expiration, the time decay on those options is extreme. Those options are going to lose value at a very fast pace just solely from time decay adding up. In this case, because I'm using a credit spread, the time decay is helping me. That's exactly what I want to have happen. So we collected 80 cents. $80 per spread is what we collected on that trade. It's our max profit on the trade. Our maximum risk is $170. So many times people look at credit spread and say, I don't want to use those. They're too risky. They're actually not. They're actually much safer than buying a call or a put. Still a fully risk-defined trade. I can't lose more than $170 per spread regardless of what happens on the trade. And the only way I lose that $170 is if I hold all the way up to expiration. I can always close it out early and take the partial loss if needed. Just a better use of our capital in many cases. Now, I said we had 5 ways of making money on the position. How does that work? When you're using a call credit spread like this, I don't care if the stock moves up, down, or sideways. All 3 directional moves are okay with me as long as price stays below 255. Does not matter to me. Even if it only closes below 255 by a penny, I'm still okay with that. I'm still going to be able to make money. How? Because I also make money from time decay adding up, like we mentioned, and I can make money if volatility decreases. So now, instead of solely relying on the move lower directionally, I can make money if the stock moves up, down, or sideways. I can also make money from time decay adding up and from volatility decreasing. I give myself those 5 ways. Any of those 5, any combination of those 5 would work. Well, you can see we did get a move to the downside. It wasn't huge. We didn't see the stock fall out of bed, but we didn't need a big move lower. With that time decay so extreme with the shorter term options, that time decay allowed that P&L to move in our favor right away. We ended up closing this trade out 6 days later. We closed it out for 19 cents. It gave me a $61 profit per spread, 35% return on my capital. Just to put some continued numbers around this, that's $183 of profit if you're risking $500 per trade or less. Just to show you that you can trade multiple spreads and still keep your risk at a very manageable level. You put this trade on with 10 contracts, you've got $1,700 of risk, and now you've got $600 of profit in 6 days. That's pretty powerful stuff, right? From a very forgiving trade, and I'm looking at these trades, I'm managing these positions in 10 minutes a day or less. Pretty powerful combination, right? Is it a smaller profit? You know, it's a 35% return versus a 75% return that we have with the long puts on Expedia. If you just base your decision off of those numbers, yeah, it makes sense to trade the long puts, right? But remember, we're going to have stretches like this on Netflix where instead of making big moves, we just kind of drift. We might pull back, but it's more of a drift to the downside. When you start to use a combination of these trades, you get the best of both worlds. I mentioned it in the previous video. The way that my portfolio is set up, I'm around 20% long options, 20% just long calls and long puts, going for the bigger returns. And then 80% of the trades that I take are these types of trades right here. Because I know more often than not, markets are going to chop. They are going to be noisy. These are going to be more forgiving trades. I love that forgiving nature right now in this type of a market. And I'm still looking at a 35% return on my capital in 6 days. That adds up very quickly. Remember, we would rather have you take 6 or 7 very small positions versus 1 or 2 very large positions. I can take 6 or 7 trades like this and still keep my risk very manageable. This was $170 of my capital per spread to put the trade on, right? So I can get those small positions on, get the diversification. No one knows what the market's going to do next. No one knows what sector, what area of the market is going to lead. Let's get exposure into many areas. Get those different layers of diversification. All right. Now, why did I set up the trade like this? Let's go over to the trade page and let's just take a look. Let's just say that this trade was setting up right now. I want to give you some criteria that you can use right off the bat. All right. So if I go over to the trade page on Netflix, with the credit spreads, you can go out 20 to 40 days like we talked about in the other video with the long calls, long puts. I wouldn't have a problem with that. But you can also go to those weekly options that have less than 20 days left. If I go out to the September 16 option with 14 days left, that's perfectly acceptable. Between 10 and 20 days is probably a good starting point if you want these shorter term trades with the credit spreads. If I open those up, if I wanted to come in right now and sell a put spread on Netflix, what I like to do is I like to go to the out of the money options. So I'm going to go over to the 220 put. Okay. I'm going to right click on it. I'm going to go to sell and I'm going to select vertical. I'm going to sell a vertical spread. It's a credit spread. The whole goal is I want to get as far out of the money as possible and still collect enough to, when opening that trade, to keep me in that risk 2 or 3 to make 1 scenario. If I take this trade right now as is, I'm collecting 72 cents. I'm opening that trade for 72 cents. I would be risking 178 to make 72. I'm risking between 2 and 3 to make 1. I'm okay with that ratio because, again, we have 5 ways of making money on the position, right? I'm not okay risking 5, 6, 7 to make 1. That's very difficult to make work. That's where a lot of times people get into trouble with credit spreads. They go too far out of the money. It's going to have a very high probability of success, but you need that. It puts a lot of pressure on the winning percentage because all your losses, if you're risking 6 to make one loss can wipe out all your gains from a whole string of winners. You want to keep that risk reward ratio in that reasonable range. And what we have found numbers wise, if you can risk between 2 and 3 to make one, we can get those numbers to work. All right. Now, if I were to put this trade on as an, I'm not saying this is a valid trade right now. I'm just walking you through an example. This is a neutral to bullish position. If I sell a put spread, I want that stock ideally to move to the upside. I just don't need it to right away. Up, down, or sideways does not matter. As long as price stays above 220, we make money. That 220 strike is the strike of the option that we're selling. Then we also make money from time decay adding up and from volatility decreasing. So again, with the credit spreads, 10 to 20 days is a good starting point as far as days left to expiration. And then when you're structuring the trade, try to go as far out of the money as possible. That still allows you to collect enough premium to keep you in that risk 2 or 3 to make one range. So that's the criteria that we use for the credit spread. So if you are not already using this strategy right here, highly, highly recommend you add it as quickly as possible. It's one of my go-to strategies. And in this market, guys, I mentioned, I don't expect volatility to go anywhere anytime soon. I think it's going to be a very active next few months. You want to have some strategies that you can go to that provide more forgiving trades. If you don't want to be as aggressive, if you want more consistency out of your returns, this is a strategy that you want to add. So if you have any questions on the credit spread, feel free to post a comment here on the video. We'd love to connect and help you add this strategy as soon as possible. If you have not subscribed to our channel, hit the button. We'd love to have you follow along with videos that we'll be releasing upcoming. So I'm going to wrap this video up here. Happy trading, everybody. Enjoy the rest of your day, and we'll talk again soon.